All right, so we are picking up from our last available for sale presentation. We're hopefully going to close this one out, and so the next journal entry is the December 31st, 2026 interest payment. And so of course we still have those 900 bonds remaining, and so we've got to kind of now record, the continuing process with those bonds, which would be the amortization of the bond, recording the interest revenue, or sorry, yeah, the interest revenue, and also of course recording any additional fair value adjustments. And so, again, we're kind of moving down our amortization table, and we're grabbing the relevant row. And so, of course, the interest payment is $65 per bond. Again, we're only applying this to 900 bonds. And so that payment is 58,500. For the interest revenue, again, we're just using that from the table, 6741. We're applying it to the 900 bonds. And then finally, the amortization of the discount, again, taking from the table, $2.41 per bond, and that's the discount. So again, hopefully not too bad. That journal entry, I'm hoping by the time we get to this one, it's very, very straightforward. And then the fair value adjustment, again, we still have those 900 bonds remaining. We need to adjust for the fair value. Again, just a reminder, because it's available for sale, these 900 bonds are kind of still sitting in that box. So we're not taking anything out of the box yet because we haven't sold them. So it's just gonna kind of sit there. And so how do we go about that? Again, sort of that step-by-step process. You start with the fair value for each bond, which is given as $980. The amortized cost is taken from the table, and that's the $994.67. The difference between those two gives us the balance in our fair value adjustment account. You can see that the amortized cost is more than the fair value. And so in this case, it's going to be a negative amount. I should have flipped those, my bad. But that's a negative balance because the fair value is less than the amortized cost. And so it's going to be a negative value. And so we compare that to the prior balance of a positive $22.74 per bond. And so the total change is that the value per bond needs to be reduced $37.41 for each bond. We apply that to those 900 bonds. And of course, because we're reducing the fair value adjustment account, we're going to credit that account, $33,669. Again, it's a credit because we're decreasing the account. That's going to be offset by a debit to that gain or loss account. And so again, just taking that information directly from the calculations we just did. Again, noting that because this is available for sale, we're using that other comprehensive income account, that permanent equity account. Again, we debit the gain or loss and we credit the fair value adjustment account. Again, my hope is that that journal entry is not too difficult. And then we look at the financial statement effects. Again, the goal here is that we're just sort of tracking things along. We're trying to figure out, how these things end up on our financial statements. And so when we think about the balance sheet, a little more going on in the balance sheet compared to trading securities, but just like held to maturity, just like trading, we're still going to report that debt investment at the par value or at the face amount. And so on 12/31, we had 1,200 bonds. And so that balance is going to be 1.2 million. And then on the 12/31/2026, we're down to 900 bonds. And so the total face amount is 900,000 instead of 1.2 million. Again, that's what we report on the debt investment account. The next account is that fair value, or sorry, the discount. Again, whether it's held to maturity or trading, we are still going to have this discount, but just taking note, remember this is a contra asset. And so on the balance sheet, it's going to be reported as a negative number. And so at each step of the way on December 31st, 2025, the balance was $7.74 per bond. Again, noting because it's a contra asset, that balance is going to be negative. And then for our 900 bonds on December 31st, 2026, again, they're being carried at $5.33 a bond. And so the total amount is negative in both cases, negative 92.88 in 2025 and negative 47.97 in 2026. We still have that fair value adjustment account. So if you remember, held to maturity does not have this account, but the trading securities do. And again, we're just looking at the balance in that account per bond, and we're applying that to the number of bonds that we're holding at that time. And so on 12/31/2025, the balance that we had calculated was $22.74 per bond. Applied to the 1,200 bonds gives us a positive balance of $27,288. On 12/31/2026, if you remember, the balance in that account is negative $14.67. Applied to the 900 bonds means the balance is a negative $13,203. And that's what we would report on the balance sheet. And then the new account that we didn't see at all with the trading securities or with held to maturity is this accumulated other comprehensive income account. Just remember, whenever we were doing those fair value adjustments, we had that other comprehensive income account, and everything kind of accumulates into this one AOCI account, kind of like retained earnings. Now, technically speaking, you could have distinct AOCI accounts for every single item, but we're just going to kind of roll them all into one. And so, there's different balances depending on the year. So on 12/31, 2026, the only thing we had to worry about was the gain and loss account. I'm sorry, in 2025, we only had to worry about the gain or loss. In 2026, we had the gain or loss, but we also had that reclassification journal entry amount from when we sold the 300 bonds. And so a little more going on in this account. But the nice thing is, whatever's going on with all of these different accounts, the balance in that account is exactly equal to the fair value adjustment account. And so those two things are a direct reflection. And the idea is everything is happening in this box. And so the fair value adjustment and the other comprehensive income, they're just offsetting each other inside this box continuously. And so we don't have to really go through any kind of calculation. It's just a direct reflection of that fair value adjustment account. And so again, that part of it hopefully is relatively easy, but maybe conceptually just got to understand there's a lot going on behind the scenes to create that balance. And so, sorry, that should probably say available for sale. Sorry about that. The label's wrong. That should say available for sale. But the financial statement effects for December 31st, 2025 and 2026 continued. Now we're looking at the income statement. I'm going to actually fix this. So give me 1 second. All right, so I just went in and fixed everything. All right, so available for sale. So on the income statement, because we're dealing with available for sale securities, there's sort of the piece that's in net income, and then there's the piece that's in part of other comprehensive income. And so net income is everything up here kind of in this gray. The other comprehensive income is down here in the yellow. And so the difference here, of course, is that this is the economic change within the year. So it's not accumulating anything. It's just the change within the year. And so thinking about the income statement, really the main thing is interest revenue in 2025. And we just take that from the 12/31 journal entry. Then in 2026, there were two journal entries related to interest revenue. This should be 630. But when we sold those securities, we did have some interest revenue on that date. So we need to make sure we include that along with the adjusting entry or the entry at the end of the year. And so those two together is where we get the 70,781. And then there is one other account, you may have missed it, but on the June 30th, 2026 journal entry, we did have that gain that we recorded where we took everything in the box, and remember we kind of threw it on to the income statement. I think it ended up being a slightly different amount than this. I kind of missed that adjustment. I think it was a different number. Maybe that was right. I don't remember. But anyway, go back to that June 30th journal entry, just verify the number. And then that is what would get recorded as part of the income statement in 2026. And then as far as the other comprehensive income, in 2025, the only thing we had was the fair value adjustment account. And so that's the only entry we had to worry about. And in 2026, we had a lot more going on. If you remember, we had the June 30th journal entry, and we also had the 12/31 journal entry. So again, remember, we did everything in the box in two different times. And so we need to include both of those in our comprehensive income reporting. And then the second thing that, again, just sort of remembering is we did have that reclassification adjustment. That showed up only in 2026 when we made that sale. And so that reclassification adjustment is $4,916. And that was a loss. And so that's going to be a negative number. So hopefully that wraps that up. Again, just trying to keep track of everything can be a challenge, but hopefully you're hanging in there. All right, so then you do have the ability to transfer in between categories in class. I went over this pretty quickly, and I'm just going to get a little slower here so that if you want to review it, you can. But basically, there's the ability to change classifications if your assumptions or your intentions change. So if you go from held to maturity or available for sale, either one of them, if you change it into a trading security, what you're going to do is you're going to record a gain or loss at the time of the transfer, as if it occurred in the current period. So basically what you do is you record, it's almost like a gain on sale. So whatever the carrying value is relative to the fair value, you're going to record that gain or loss. And then when you classify it as a trading, it's going to come on your books at that updated fair value. So you're just going to recognize the gain or loss, and then you're going to carry it at the new revised fair value. So after that, there's going to be additional fair value adjustments, but it would be done under the trading security guidelines. You can also go from trading to held to maturity. Similarly, you're going to record that gain or loss as if you sold it, even though you didn't. And then you're going to bring it on your books at the fair value at whatever the revised amount is. So anytime you do a transfer in between categories, if trading is involved, you will recognize a gain or loss as if you sold it on that date. Even though you didn't, you would act as if you sold it, and you're going to bring it back on. And then finally, hold on, just got to pause here. That was had a call come in that I had to take. But anyway, looking at the other one. So again, anytime trading securities are involved, we're going to have you're going to act as if you sell it. So you're going to have a gain or loss, and then you're going to bring it on to whatever the new category is at that fair value, and then kind of go from there. So, and then the other example is where you go from held to maturity to available for sale. You'd have still a gain or loss, but it would be a part of your accumulated other comprehensive income. So it's not going to be on your income statement. It's going to be part of the other comprehensive income. And then finally, if we go the other direction, you're going to move any cumulative gain or loss that's in other comprehensive income. You're going to move it to net income. Basically, you're going to take everything out of the box and throw it on the net income, and then just treat it as held to maturity going from there, depending on whatever the fair value is at that time. So again, with anytime trade is involved, you're going to have gains and losses on the income statement. Anytime you have available for sale involved, if you're going from held to maturity to available for sale, it's going to be part of other comprehensive income. If it's going the other direction, it would be part of the net income. So hopefully that gets us there, and we'll pick up with the next one here soon.